Hello, everybody, and welcome to another episode of KN Talks, looking at issues that might be of interest to people who are looking to open business in the US. I'm delighted to be joined today by Jamie Baker and Michael Campbell from KRD, who are accountants and excellent people to talk to if you are thinking about opening up a US branch or starting a business in the US in some other way. In particular, they have real expertise on the thorny issue of state taxes, which is something which in the UK obviously is not an issue for us. We just have taxes which are broadly national, whereas state considerations can make a significant difference. So it's great that they're able to talk to us. Jamie and Michael, thanks for joining me on the podcast today. Perhaps you could introduce yourselves and say a little bit about KRD.
Yes, hi. So I'm Jamie Baker. I've been with KRD for a little over a year and a half, and I have about 17 years of tax experience in the state and local tax arena and just general taxation. The KRD, we are a public accounting firm out of the Chicago, Illinois area, and we have specialties in all areas of taxes and tax help, such as assurance, international auditing. So our service line is robust, and one of those includes the state and local tax practice. So we're excited to be here today.
Thanks, Jamie. And Michael?
Hi, I'm Michael Campbell. I lead the international tax practice for KRD. I've focused on international tax most of my career, but have experience in federal, state, and other specialty tax areas in the U.S. Thanks for having us here today. I'm very excited to talk about investments into the U.S.
That's great. Thanks. So, Jamie, shall we open by talking a bit about what kind of things people looking to open a US operation might need to think about from a state tax perspective?
Sure. So, I think this is a great question when we think about where an entity might be thinking about operating in the United States, because we do have 50 states plus the Washington, D.C. district. And so every state is different. So some of the considerations that you want to think about might first need to be about what your business is and what your business needs are. And that might be driven by your industry type and whether or not you intend on having a physical presence in a particular state. So obviously one consideration is where you want to incorporate, but that might be also you might want to be thinking about where you're going to be operating, because sometimes entities will register and incorporate in one state and then choose to operate in another, and that might not be the best choice. So thinking about where you want to operate would be a good starting point.
And what kind of differences might it make to somebody in terms of the state that they choose from a tax perspective? Are there some that are easier from a tax perspective than others, either from a compliance perspective or a tax rates perspective? What kind of thing would you need to be looking at if you were comparing a couple of states?
Right, John. So thinking about the state's tax structure is also a very important consideration. Every state, they either they have some type of tax structure, but not every state imposes or levies a corporate income tax. Also, the corporate income tax rate varies. So some states are very high, while others are more friendly. Also, sometimes in lieu of a corporate income tax, the state may have a gross receipts tax. So that might be a consideration, or a franchise tax, which is based on net worth. So yes, the tax structure is very important, specifically because of the lack of uniformity between the states. So choosing a state that has a friendly tax rate is certainly a consideration.
That's interesting. So if you were a tech business, for example, what would you presumably be looking for a business that had, relatively low tax rates, but perhaps you might be more inclined to look at a state which had a franchise tax on the basis that your net worth is probably going to be relatively low if it's all just IP generating income.
Sure. Yeah, exactly. So that's a good point. And also when you think about the tech industry, for instance, some other considerations outside of just the tax rate might be the regulatory environment, and the basically the privacy laws in a state. Whether or not there's economic stability for that. Some states also seem to foster growth in certain industries versus others. So tech, there's normally California is associated with fostering growth in the tech industry. So it might make sense to examine California. They do have a high tax rate, but their overall other opportunities may outweigh the fact that that tax rate's high. So there's other considerations that should probably be considered in addition to just the tax structure.
That's great. And do individual states try to encourage people to open in their jurisdictions by offering incentives? And if so, what kind of incentives do they offer?
They do, and I believe that's in our next podcast. But they do have quite a few incentives. In fact, oftentimes businesses they do want to promote economic development, and they do want to encourage businesses to grow and to expand in their area. So they offer incentives that might be directed towards certain industries, or that they may be part of a ploy to get to create jobs and to increase capital investments, and so incentives is a great way to encourage businesses to come into the area. So that's definitely a topic of conversation that would be helpful to talk through.
Sure. And are those typically kind of tax break focused incentives, or are they more kind of direct grant? Does it depend on the state? A real mix depending on.
Yeah, it depends on the state because it's not really just the state. The localities also offer their own incentives, and they can be credits. They can be in the form of credits for certain tax liabilities. They can actually be like refunds. They can be it could be a property tax abatement. It could be withholding tax subsidies. It could be exemptions on sales and use tax. When we think about credits that could be retroactive, they could be refundable, they could be carried forward. So lots of varieties and different types of credits and incentives and refunds and things like that. And again, it's not just at the state level, it's also at the locality level. And usually, John, to really be able to capitalize on some of these credits, there's usually a process that you have to go through to qualify for this program. And it's usually some type of application, but the most important part of this conversation is the fact that you have to do it prior to starting the project. So being proactive is very important.
Definitely have a chat with you first and make sure that you've got all of those things lined up before you actually start producing things in the state or doing
Absolutely.
work, acquiring property, that kind of thing.
Absolutely.
Excellent. Thanks very much, Jamie. And Michael, from an international tax perspective, if somebody is looking to come into the US from the UK or EU, what kind of entities might they need to look at, and how are they taxed? Because you have some concepts in the US that we don't in the UK. So, for example, we know you have LLCs, which are not quite the same, I think, as either a UK limited company or a limited liability partnership over here. So perhaps you could talk us through some of the options there.
Sure. We have a lot of options. Step one would be direct investment, where a UK entity would be taxed directly by the United States government. That's going to come with a corporate tax at 21%, plus any state taxes that the UK company might be liable for. In addition to that, they would be subject to tax under what's called a branch profits tax, which essentially is going to tax any dividends with a withholding tax. To get out of that branch profits tax, usually we recommend setting up an entity in the United States. And you mentioned limited liability companies. Those are our favorite because we can set them up in the matter of a few hours, get them a U.S. tax ID, and be up and running. in no time. LLCs have the flexibility of being treated as an entity that's separate from its owners as a U.S. corporation, or as a flow through. Can be a partnership, or can be as if it has one owner, then it would be taxed as a single member LLC, and essentially be a flow through. The corporate structure in the U.S., I think, is beneficial because a corporation in the United States will act as a blocker that'll block the income from flowing up to the UK company, and it'll have just one level of tax instead of potentially being subject to withholding taxes.
So am I right in thinking LLCs essentially see through for tax purposes? So they look at that it's taxed in the hands of the owners, the profit, whereas a corporation is treated as its own person for tax purposes.
Right. So a corporation is going to be separate. We also have partnerships that the owners would be subject to tax. So for a UK investor who's invested into a corporation, the corporation is going to pay all the tax. If a UK person is invested into a US partnership, the UK person is going to be subject to tax, and that comes in two forms. One is a withholding tax that the partnership is responsible for. So any item of income that's distributed or earned during the year by the UK owner, they're going to be subjected to a withholding tax. Additionally, they're going to have to file their own US tax return. If it's a UK entity, they would file Form 1120F and pay the corporate tax. It's already been withheld by the partnership, but they still have a filing obligation. And if it's a UK individual, they're going to have to file a 1040-NR, which is a non-resident individual income tax return. And again, that partnership has a withholding tax that they have to pay. To get around that, we recommend that UK investors invest in what we call a blocker corporation. So you can set up a separate entity in between the UK investor and the US partnership that's going to pay the US tax. When that investment has run its course and the UK investor wants to get out of it, they can exit that UK or US blocker corporation tax-free, because cash is not subject to tax in the US for a UK investor. They can actually exit that through liquidating distribution, or through a sale, and not pay any tax on the capital gain there in the U.S.
That's interesting. So if you have a blocker corporation and it wants to make distributions to its owners as it's going along, will those distributions also be subject to the dividend withholding you mentioned before, or are they exempt because of the nature of the corporate entity?
Yeah, so they would be potentially subject to a 30% U.S. withholding tax. That's our default rate on dividends paid by a U.S. corporation. But income tax treaties can reduce that rate. In some situations, the rate gets reduced all the way to zero. So for a UK investor, you could qualify for potentially a 0% rate on dividends. So you'd be paying 21% tax in the United States. That could change very soon to either 30% or 20%, depending on who wins the upcoming election in November. Maybe by the time this podcast is out, we'll already know the results. So yeah, it is, the blocker corporation is very beneficial, and you can have a separate corp, which is we call it an Inc., or you can set up an LLC and file an election to have that LLC treated as a corporation. That's the fastest way, and I think the easiest. And from a state tax perspective, they generally have all of the protections that you would get from a full corp, but none of the additional things like having to have a board of directors and all the additional filings that go along with that.
So it sounds like from a tax perspective, it's a bit of a no-brainer to put one of these blocker corporations in place, if nothing else, just to save yourself the hassle of having to do a US tax return as well as a UK or wherever tax return, and work out what the difference is in your tax treatment in the two jurisdictions for the same profits is going to be.
Absolutely. And that the benefit of separating your activity from the U.S. activity. We call it ring fencing, right? Fencing your tax risk. Otherwise, your profits in the UK might be exposed to U.S. taxation.
Right.
That's really interesting. Thank you. So, sorry,
that is interesting. Yeah, but there is some combined filing requirements that certain states do impose. So we do want to throw a little bit of caution to say that if there's a combined filing requirement for a corporation, there may be a mandatory where it's a worldwide reporting. So they may get drawn in without knowing that. So and states are also not bound by U.S. Tax treaties. So that's just another kind of layer of consideration when we think about the complexity of states and how that could play into some of that conversation as well.
That's great. And so I guess my takeaways from this are state tax is incredibly important. Obviously, there'll be lots of business drivers about existing networks and existing clients and just convenience of getting a flight, which will factor in when you're deciding where to open up in the US. But really thinking about what advantages you may choose from picking one state over the other, particularly if they're quite close to each other geographically, can make a big difference. And so can those state incentives, which people should look into and bear in mind before they actually settle on where they're going to land and start their US business. Really interesting stuff. And the blocker corporation, as we said, I think just seems like a no-brainer, because really nobody wants to do two tax returns if they can possibly avoid it. So thank you very much. It's been a real pleasure to talk to you on these subjects, and I look forward to speaking to you shortly about our next issue, which is some of the issues that people might find once they have actually established their business in the US and need to think about tax issues they're going to come across. Thank you to everybody who's been listening. Please do click on the button to subscribe to our YouTube channel, which is something we're encouraging people to do so that you can get more of this content, not least get a notification of Michael and Jamie's next video, which will be really interesting. And yeah, thank you very much.